Recognizing growth stocks is a critical aspect of investing as it allows investors to capitalize on companies that are expected to grow at a faster rate than the overall market. By analyzing key financial ratios such as revenue, cash flow, price to earnings, price to sales, and the price/earnings to growth, or PEG ratio, investors can gain insights into a company's valuation, growth prospects, and potential for future profitability. Let's explore some of these ratios and decipher why they are important. Ratios provide a view of a company's valuation by considering both its earnings growth and price to earnings ratio. The PEG ratio is calculated by dividing the price to earnings ratio by the growth rate of its earnings for a specified time period. A PEG ratio of 1 or less is typically considered to indicate that the company is undervalued, while a PEG ratio above 1 suggests overvaluation. The PEG ratio can be used to compare companies in different sectors with varying earnings growth rates, offering a broader perspective on valuation. Let's consider a hypothetical U.S. technology company, Acetec, as an example. Acetec has a PE ratio of 20, indicating that investors are willing to pay a premium for its stock. However, the company has an expected earnings growth rate of 30% over the next 3 years. This results in a PEG ratio of 0.67, suggesting that Acetec stock may be undervalued relative to its growth prospects. The price-to-sales ratio divides a stock's market capitalization by total sales over the past 12 months, providing a measure of how much investors are paying for every dollar in annual sales. A low price-to-sales ratio can indicate that a company is undervalued, especially if it's cyclical or has no earnings. Growth can be driven by focusing on the company's core business areas, where it has the most experience and expertise, as well as by nurturing growth in adjacent business areas. Here's a step-by-step guide on how to calculate the expected earnings growth rate. 1. Calculate the historical earnings growth rate. Compare the earnings per share, EPS, from one period to the next. For example, if a company's EPS this year is $2.67 and last year was $1.78, the earnings growth rate can be calculated as 2.67 divided by 1.78 minus 1, multiply 100 equals to 50%. 2. Use analyst estimates. For a more forward-looking perspective, use analyst estimates, which can be found in tools like TWWS Fundamental Explorer. These estimates often cover a period of up to 5 years and provide an annualized growth rate. For instance, if analysts predict a 10% annual earnings growth, this would be the expected growth rate for the PEG ratio calculation. 3. Consider company-specific growth factors. Evaluate factors such as new product launches, market expansion, or cost-saving initiatives which can influence future earnings growth. These should be considered alongside the historical growth rate and analyst estimates to get a comprehensive view of the company's growth potential. Investors should not rely solely on ratios, but should also consider other financial metrics and factors such as the quality of earnings, cash flow, profit margins, and debt levels to ensure that the earnings growth is sustainable. Additionally, it is key to compare a company's valuation metrics with those of its industry competitors and to consider the future growth potential of a company rather than solely relying on past performance. By considering and applying these financial ratios, expected earnings growth rate, analyst estimates, and evaluating company-specific growth factors, investors may identify growth stocks and potentially capitalize on future growth opportunities. Thanks for joining us. Don't forget to like, subscribe, and hit the notification bell for more investing insights.